Welcome back. Markets are now higher across the board. Cleveland Federal Reserve President Loretta Mester just telling our own Jennifer Schonberger that she still sees 3 rate cuts this year. Joining us now is Chip Hughey, Truist Fixed Income Managing Director. Hey, Chip, good to see you. So very interesting to hear those comments from Mester. And sort of echoing the sentiment that we've heard that the Fed still feels like it needs to see more evidence. And I guess the PCE report today also sort of brought that home. What do you think the Fed needs to see, and what do you want to see that lets you know that they can do it?
I think they clearly just want to see more evidence that what they have seen so far is not sufficient enough. I think today's PCE data really confirmed that it is going to be that bumpy path down to the 2% target. And so they just need more time and more data to come in and confirm that inflation is cooperating. So I think they're taking a very data dependent and pragmatic approach. I really enjoyed her comments a lot. And we think that by the middle of this year, around the summertime, that evidence will have built sufficiently that the Fed can move forward with that initial rate cut and ultimately lower by 25 basis point increments roughly 3 or 4 times before year end.
It's interesting, Chip, because, Larry Summers, our former Treasury Secretary, he recently made some headlines, Chip, and obviously when he speaks, people listen, and he thought there was actual meaningful risk, his words, that the next move in rates was actually upwards, not downwards. But it doesn't sound like you agree with Dr. Summers.
Yeah, I think that where the policy rate currently is set is at a very restrictive level. And it's growing more restrictive as inflation continues on this bumpy but still downward trend. So I think that the current setting now is sufficient to have the effect that the Fed wants, right? To cool demand, to get inflation to fall. I don't think the Fed is going to need to continue to raise rates, but that was what we've really been saying since late last year, that it was going to take time for the Fed to actually entertain rate cuts. They had the experience with inflation over the course of the past couple of years that is making this process a very cautious and slow one. But I don't think they'll have to add to the tightness to continue to see the progress that they've put together over the course of the past 6 to 12 months.
And do you think that this sort of financial condition tightness will continue even if the Fed starts to cut? In other words, will rates really come down meaningfully even when the Fed does finally begin?
Yeah, I think that any kind of cuts would be completely predicated on inflation cooperating and coming down. So if the Fed funds rate is coming down sort of in lockstep with inflation and maintaining that sort of real yield differential, I think that is consistent with a kind of downward pressure in yields. I think that they would follow certainly in the front end of the curve where you're more policy sensitive, but out in the intermediate long end as well.
So Chip, if I'm looking at the yield on the 10-year right now at 4.25, near to intermediate term, you think we're sort of range bound here?
I do think we're somewhat range bound. We have seen some upward pressure kind of return when you get concerns around budget deficits and all of the strong Treasury issuance that will need to continue to sort of backfill those deficits. So we do expect some periodic upward moves in response to that. But ultimately, we do think that the broader trend as we progress through the year is to lower yields. Now, inflation is still somewhat elevated relative to what we've seen over the past decade or so. So that probably raises that floor a little bit. But from where we are now, we view the 10-year in that 4.25 range as fairly valued. And if we saw those upward moves based on concerns around maybe Treasury supply or deficits, that likely would create more of a buying opportunity in our minds ahead of what we expect to be a bumpy but still downtrend in yields.
And I was going to ask you to dig into that a little bit strategy-wise, kind of where you're looking on the curve right now. And also if you're talking to a retail investing audience, right, and maybe they're looking at it through bond ETFs, for example, are there sort of areas, subsectors that you think are most interesting?
Yeah, I think for those that are seeking really high quality passive income, that the front end of the yield curve, say T-bills, for instance, is really compelling because we do think the Fed is going to be able to ease policy as we move through the year. And therefore, that should put downward pressure on the front end of the curve. So for those that are kind of saying, when is the right time to get that money to work? Our message is, probably a little bit of urgency at this point, right? Go ahead and get that money to work. We do think that those yields are going to fall. I think I would use any upward pressure from here in this fair value range. There's a big technical support in the 10-year at about 435. If we were to break through that, I think that we would kind of view duration instead of more neutrally or fair valued as more attractive. And so I would be looking for that kind of opportunity for extending duration. Right now, I would be a little bit more patient on the duration front.
And then I'm curious on the corporate side too, what you think, because there's just been enormous issuance, right? There was a record, I think, in January and February for the amount of corporate debt coming to market. Does that also represent a really good opportunity?
Yeah, I mean, you would expect with that, you're exactly right. Record-setting issuance in January and February in investment grade, and you would expect that kind of supply to put upward pressure on spreads, right? To make their relative valuations a bit more attractive, to entice investors to get into the market and purchase that. We did not see that at all. In fact, we saw spreads continue to tighten. So on a relative basis, credit still looks, whether it's investment grade or high yield, looks pretty expensive on a relative basis. Now, absolute yields remain attractive, but for those sort of looking for a timing on a relative basis, for a more attractive entry point on a relative basis, we would be a bit more patient and let those spreads start to reflect, the sort of downstep in growth that we expect going forward. And so right now, those spreads are well below average, in fact. So even getting back up to more average levels would be more aligned with our sort of economic outlook. Right now, we don't think that compensation is really sufficient at this point.
Chip, thanks so much for joining us today. Appreciate it.
Thanks, Josh. Appreciate it.